This is one of the most bullish backdrops that we've seen in a while. When the Fed has cut in the absence of a recession, that has been very bullish for equities. China, which has finally woken up, and they've realized that the only way to support their economy is really to stimulate forcefully.
As we turn the page on the third quarter and welcome in the last 3 months of 2024, where will the Fed go next with interest rates, and how will it affect the economy? I'm your host, Andrew Brill, and we'll answer those questions and a bunch more coming up right now. I'd like to welcome Geo Chen to Wealthion. Geo is the author of Fidenza Macro on Substack, which is a global macro view of the world. He's a trader with over 2 decades of experience with Credit Suisse and Royal Bank of Scotland, now manages global macro strategy for his family office. And Geo's a philanthropist. Geo, welcome to Wealthion. So glad to have you.
Thanks. Great to be here.
So tell us a little bit about yourself since it's your first time here on Wealthion. How did you get started in the banking business?
Yeah, so I've been a trader since the dot-com bubble, actually. So 25 years. Started trading during the dot-com bubble, managed to turn, $5,000 into 800. And then after that, I still wasn't discouraged, and I really wanted to get into trading. So I got a job in FX trading at the Royal Bank of Scotland. I was really inspired by books like written by Jack Schwager, Market Wizards, and that's where I started my career. So worked in London, New York, then moved to Singapore, where I was the desk head in FX at Credit Suisse. And about 7 years ago, I decided to go out on my own and trade my own capital full time. So I've been an independent trader ever since.
And you're a philanthropist. Tell us about Rainforest Trust. And I was fascinated by this because I was looking at your Substack and seeing the pictures of you out there. And my son spent some time in Uganda studying chimpanzees, but there's always poachers and people trying to ruin the rainforest. So tell us a little bit about Rainforest Trust.
Yeah, that's great. So I've been really interested in fighting deforestation for almost 10 years. I realized a while ago that deforestation is the cause of a lot of world problems, ranging from climate change to the loss of biodiversity. And also, it just ruins the lives of the people who live in and around the rainforest. I had this idea, like, what if you just bought a lot of rainforest to save it? So I Googled, how do I save rainforest? And I came upon Rainforest Trust. So that started a journey of learning about conservation, of giving money to save rainforest, and it's been a great ride. I've expanded to nature conservation in other areas, such as oceans. And through my foundation, we also try to alleviate climate change, climate refugees as well. That was the start of my philanthropic journey, but trying to save rainforests remains at the heart of my philanthropic goals. And that's why I was in Mozambique just a couple of weeks ago looking at one of our projects in Gourgoso National Park, where Rainforest Trust helped to save thousands and thousands of acres there, and basically preserving, the territory of all kinds of species, ranging from elephants, hippos, wildebeests, just all kinds of wildlife there. It was amazing.
Very cool. And it's a lot of fun to see those wild animals, because it's not something I'm here in New York City, so it's not something we get to see unless we go to the zoo. So it's to see them in their natural habitat has to be very, very cool.
Yeah, it's totally fascinating. A lot of fun.
So now that we know how to save the rainforest, we just look up Geo and have him help us out. How are we saving the economy, and what's your view on the present economy?
Yeah, on the present economy, I'm feeling pretty positive. I think that this is one of the most bullish backdrops that we've seen in a while. So what we have right now is a Fed that has pledged to cut as much as needed to support employment. That in itself is very bullish, and we're not even in a recession. So whenever the Fed, historically, when the Fed has cut in the absence of a recession, that has been very bullish for equities. Um, and we're not really too worried about inflation as the inflation prints have been coming in pretty low, pretty tame. So that's not really a concern for a Fed. It's not a roadblock for them to cut as deep as they want. Now, on the other side of the world, we have China, which has finally woken up, and they've realized that the only way to support their economy, to get the economy out of this huge balance sheet recession, wealth recession, is really to stimulate forcefully. And they've been stimulating and little bits and pieces in here, and trying to be like fiscally responsible, but that hasn't really done the trick, because the real estate bubble that was building for decades has popped, and there's like trillions and tons of trillions of real estate, and really bad loans on bank balance sheets. The average Chinese consumer has most of his wealth in real estate, and it's illiquid, and it's down a lot. So it's gonna require hundreds of billions, trillions of dollars of stimulus to really get the Chinese economy going. So I think what they announced last week, a combination of both very forceful monetary and fiscal measures amounting to over 3% of GDP, I think that's a start. Now, if they just do that and nothing else, then that would end in disappointment 1 or 2 quarters from now. But the tone from the announcements last week suggested that more is coming, and that they see an urgency in an urgent need to support the economy. So me, along with most other economists and retail, and I mean everyone's piling into Chinese equities right now. Um, you know, I think it's for good reason. I think the economy is likely to rebound from here, and it's just a matter of how much and how long this rally is going to last.
Now they're facing almost the opposite problem of what we're having here in the United States. Their real estate values are plummeting, while the real estate values here in the States are just ridiculously high, and in essence priced many people out of the market. Is it a population issue? Are there fewer people looking to purchase homes, so the prices are plummeting in China?
Yeah, it's an issue of oversupply. Um, what China did was they provided liquidity to banks, and they provided subsidies to banks, and told the banks and developers to just build, build, build. And the premise was that we have all these people in the countryside who are going to move to the cities, and that has happened. Um, Most of the people who are ever going to move from the countryside to the city already have. So, you know, developers just kept building, and at at the end of the day, there just were not enough people to buy and live in those apartments. Um, so, you know, everything came crashing down a couple years ago, and it's reverberated through the banks, which have all these loans where the value of the asset backing those loans is no longer, what it was worth at the beginning. They've loaned to developers. Developers have a bunch of unsold homes. Some of them are not even, completed yet. So there are big holes everywhere in the balance sheets of the real estate developers, in the balance sheets of banks, and in the balance sheets of the average consumer. So, you know, similar to long-lasting bubbles, like for example, this is compared to the bubble in Japan, which had a similar trajectory, multi-decade bubble in real estate, which eventually crashed. This is the depth and magnitude of this bubble is quite large, and therefore it's going to take a lot of capital and also time to dig the economy out of it.
So getting back to home, you had written that the 50 basis point, and there's lots of debate over whether the 50 basis point cut was too big. Was it right on? You thought that there was a good thing. Explain to us why the 50-point cut was dead on.
Yeah. I think what Powell was going for was to go with the decision of least regret. So right now, the U.S. economy is finally balanced. There's not a lot of hiring, but not a lot of firing going on either. If he delivered a 25 basis point cut only, the market was expecting a little bit more than that. So the market would have been disappointed. Stocks would have sold off, and it really would have sent a message to the economy that the Fed is behind the curve, or it doesn't have the economy's back. And I think consumer sentiment would have continued to weaken, and resulting in the unemployment rate continuing to tick higher. So we did trigger the SOM rule, which was what that rule is when the 3-month moving average of the unemployment rate goes up by 0.5% from the cycle's low. So when that happens historically, the economy has gone into recession every single time in the past. So that in itself means that when unemployment starts to tick higher, there's a lot of momentum behind that, and you need to stop that momentum with something forceful. So I think a 50 basis point cut and the message that more cuts are on the way, that was forceful enough, but a 25 basis point cut wouldn't have done it. I think it's really important for the Fed to get its messaging right at the beginning of any cycle, whether it's cutting or hiking. So imagine if back in 2022, when inflation was ticking higher, rates were at zero, if the Fed had hiked by 50 basis points instead of just 25, like that would have sent a message that they were ready to fight inflation. And if they had just been ahead of the curve a little bit more, then we might not have had to end up at 5.4% in Fed funds. Maybe they wouldn't have had to hike as much. So I think what we're seeing today is the mirror image. Now this time they've led with a 50 basis point cut. It's more forceful. It means that they probably won't have to cut as much down the road because now the economy is going to be on better footing.
I want to touch on unemployment because you made a very interesting point that companies aren't firing, but they're not hiring either. So we're in this place where companies are running. Actually, earnings were pretty good, and we just ended another earnings season as we flip the page to October and end the third quarter. But my question is, are we entering a different time where companies are going to run leaner? They're going to have part-time employees instead of full-time employees, so they don't have to foot the bill for insurance and stuff like that, health insurance. Are we in a changing time? I mean, COVID had a lot of people working from home. Office space, especially here in New York City, a lot of it is empty. So there seems to be a changing of the time. Do we need to readjust some of our figures to get a better handle on what unemployment or employment is going to look like going forward? And now with AI, some of those jobs are going to be replaced anyway.
Yeah, it's quite possible. And what you're talking about, corporations delivering, similar, the same or better revenues on a leaner staff, employing fewer people, that's actually good for equities. It means productivity is going up, GDP per capita. So, and high productivity tends to be very good for the market. Whether it's going to be good for, your average worker, like the truck driver, delivery people, the people who might get displaced by AI, that's a different story. But my expectation, like with every previous transition in technology, I think those jobs will get repurposed. People will retrain. People will find other careers. So I'm not too worried about that. I do think that what happened during COVID, where people, they did reshuffle. They left the jobs that they didn't like, and they moved to, you know, careers that they wanted. They left cities or places where they were living to go closer to home. I think generally people just sought what they were looking for in life, right? It was kind of like it shook things up. So people are happier and people are probably more productive now than before COVID. So overall, I think the economy is in a better place. It's in a more productive place, which overall is going to be good for equities.
This show is sponsored by BetterHelp. It's finally happened and was only 4 years in the making. The Fed has cut rates by 50 basis points. Yes, it was a little surprising, but maybe they see bumps in the economic road going forward. And maybe there are bumps in your personal economic road that are weighing on you. Or maybe there are other things that are on your mind, keeping you from thinking about all the good things in your life. It happens to all of us. We walk around with the weight of the world on our shoulders and look at others thinking their lives are perfect with no worries or cares in the world. Everyone has worries and things they think about all the time. You can't let those things get in the way of the fun things you want to do and explore, or the things you're curious about and want to tackle. It's why I speak to someone. It helps to ease some of the negative thoughts and gain a new perspective on some of the things that are floating around in my head. And believe me, there's plenty. If you need to talk to a professional or are thinking about giving therapy a try, give BetterHelp a try. It's easy, online, convenient, and flexible to fit your schedule. Just fill out the questionnaire, get matched to a licensed therapist anytime. Rediscover your curiosity with BetterHelp. Visit betterhelp.com/Wealthion to get 10% off your first month. That's BetterHelp, HELP.com/Wealthion. So they cut 50 basis points, but all along they're saying, oh, we want to get inflation down to 2%. It's not far, but it's not close. I guess we're just under 3%. So, Geo, what happens? And we're in a situation now here in the United States where there's now a dock workers strike. They've basically shut down the waterways from New York all the way to Texas. I think there's somewhere around 12 or 14 ports. Is there a possibility of inflation ticking up, especially with all this merchandise sitting at the dock somewhere and not moving?
Yeah. So in previous strikes have had a temporary effect on inflation, particularly wages, and it's rarely, it rarely tends to last. So I don't think that the strikes going on at the ports on the East Coast are really going to have a lasting impact on inflation and wage pressure. As for the Fed cutting by 50 when the Fed funds is not yet at 2%, there are two things I have to say about that. First of all, in previous Fed cutting cycles, they've tended to, in the past, they've started when inflation was actually a lot higher, because inflation tends to be a lagging indicator. And in previous cutting cycles, the Fed felt a need to cut because they saw signs that growth was slowing, and because inflation lags, it was in the past it's been as high as three on a three handle, four handle, but as growth slowed down, inflation followed. So so compared to previous cutting cycles, 2.7 in the PCE is actually pretty low, and as for where the Fed wants inflation to be in the long run, I actually think that they don't mind if inflation bottoms out around here. Like they say that they're aiming for a 2% inflation target, but if it starts to tick back up to 3, I don't think that's really going to stop them from cutting further because inflation running at around 3 is actually the ideal scenario for both really for the sustainability of government debt because it increases the denominator of the debt to GDP ratio. So in order to get their debt to GDP ratio lower, you actually want GDP to be inflating a little bit faster than normal. And that's the whole phenomenon of governments wanting to inflate away their debt. So I do think that we're probably going to have inflation in the long run above 2%, in like maybe 2.5 to 3.5% range. And that's going to be perfectly fine for the Fed.
So it's unemployment that they're or employment, whichever way you want to look at it. It's that's what they're really worried about is getting people to work so that they can actually spend money again and keep the economy moving.
That's right. Yeah, they're trying to keep the cycle going, keep the music playing, and in previous instances when the Fed has cut in the absence of a recession, what I would call a mid-cycle cut, that's been very bullish. We saw this happen in 1998 when the Fed cut by 75 basis points over 1 or 2 months, and this was during the LTCM crisis and when Russia defaulted on the debt. So we saw what happened after 1998. We had a massive bull market that ended up in the dot-com bubble in 2000.
Right. I guess the dot-com bubble helped that along too, where the technology. Are we in that same sort of bubble where AI is going to help this along and push the bull market even further?
Yeah, I don't know if we're going to see something like the tech bubble. And I don't know if AI is going to be like the 2025 version of the 2000 tech bubble.
Right.
At the moment, I'm more bullish on like cyclical sectors of the economy rather than AI names actually. I think sectors like the small to mid caps are actually going to outperform for a while, just because those sectors have been beaten down and just been going nowhere for a long time. So and they're also cheaper as well, and they contain a lot more interest rate sensitive sectors of the economy like regional banks, housing, manufacturing. So I think those are more likely to inflect higher, whereas a lot of the growth in AI and the Mag 7 has already been priced in to a certain extent. I'm not saying that Mag 7 or S&P are going to sell off, but they might be in for a bit of underperformance relative to the more cyclical sensitive names.
You mentioned the debt, and now with interest rates coming down, obviously, although I don't know how bond prices kind of popped up a little bit and now they're coming down. It's been a little bit of an anomaly, but with the debt continuing to rise and now with interest rates coming down, it's going to be harder to service that debt, and that's an inflationary problem, isn't it?
Yeah, it's I think the debt is always going to be an issue, and the U.S. government is still running a budget deficit, quite a large budget deficit, and it doesn't seem like that's going to change anytime soon. Whether Kamala wins or Trump wins, neither of them are that focused on reducing the budget deficit. So, that's going to support spending, that's going to support the economy, but that's also going to support inflation as well. So, and I think that means that yields in the long run are also going to be well supported. So I actually think that we might have seen the bottom in Treasury yields for the cycle. At least I'm willing, that's how I'm positioned. And whether you're talking about the 2-year Treasury yield or the 30-year, I think they're all going to bottom out from here.
They're going to go lower, you think?
The yields will bottom out, and the bond, yeah, the treasuries will go lower.
So is the debt something if they're just going to continue to print money, so to speak, is the debt something we really have to worry about?
You know, this is I I think sometimes, but I don't think it's going to be. I don't think this is all going to come down to a singular moment where, like, there's a debt crisis where there's a complete collapse in the faith of, you know, treasuries and the US dollar. I think it's just going to result in moments like we had maybe um, last September and October when the market was freaking out a little bit about the supply of treasuries of term premium and, 30-year yields went up to like 5.5%. And the Fed, I mean, the Treasury had to do some tweaking of its issuance, um, issuing more on the short end T-bills, and in order to support the long end. They're going to have to do more gymnastics in order to keep the yield from getting out of control. So I think we're going to see a little bit more of that going forward, but it's going to come in fits and starts. Like right now, I don't think that the market is going to be too worried about the debt. I think there are plenty of there's plenty of demand for U.S. Treasuries, um, but I do think that the market, uh, you know, upgrading its prospects for the growth of U.S. economy. I do think that yields are too low because right now, for example, we have the curve pricing in the Fed funds rate going down to about 3% by middle of next year.
Mhm.
That's a lot of cuts, and it also means that the Fed is going to have to deliver like one or two 50 basis point cuts between now and Q1. And I don't really think the data is going to support that. I think the data is going to start turning higher and improving from this month onwards. So I think maybe we'll end up landing at 3.5% in Fed funds, give or take. And that means that yields at every point in the curve are too low at the moment.
So with bond prices going down and bottoming out, as you say, we have a sister company, Hard Assets Alliance, who deals in precious metals. What are your thoughts on gold and precious metals at this point?
Yep. I've been a long time bull on gold, and I think it's a vital part of every like long-term portfolio. However, I recently have been reducing my allocation to gold, and you know, tactically, I prefer to trade gold from the short side. And I know that this might disappoint some gold bugs out there. I know a lot of people who are usually bullish gold, but the reason is that if we if the market is pricing um, the Fed cutting down to 3% by middle of next year, but we only get to 3.5, then that should be bearish for gold because it means that right now what we've seen is like peak dovishness for the Fed, um, or the price of money is really the cheapest, and it's only going to get more expensive from here. So if the 2-year Treasury sells off from here, if for example the SOFR futures um, sell off from here, that's actually negative for gold. So from a liquidity standpoint, I think we've probably seen the highs in treasuries, and therefore are likely to have seen the highs in gold. Um, Also, from a price and positioning perspective, it's just if you look at a daily chart, weekly chart, it's just very overbought. And positioning also reflects this. Positioning is really, the highest it has been in a while. Maybe since 2020, 21. It's definitely towards the high end of the historical range. And whenever position gets this long in gold, that tends to lead to a bit of a correction and in a sideways period. So, I think that people have flocked to gold for safety and protection from monetary inflation. But, if we see the big cyclical upturn that I'm expecting, then there's going to be a pretty significant rotation out of safety into riskier assets, riskier stocks. And one example would be, a reverse. So one example would be the fact that a lot of people in China have resorted to buying gold, really as a store of wealth, because once they lost real estate as a way to store of wealth, and they lost faith in equities as a place to invest, they started to buy gold. Now that the China economy and markets coming back, they might choose to sell their gold and get back into Chinese equities.
So I want to ask you about commodities also, because they've been suppressed for quite some time, and oil is now down right around $70, $71 a barrel, which is, I guess, normal, but also kind of low considering what's going on in the Middle East, what's going on with Russia and Ukraine, which is now has taken on a ridiculous length of time. But with the uneasiness in the Middle East, you'd think oil would go higher, but commodities have been suppressed. And now with the Chinese economy that they're trying to pump that up, you would think that commodities would be a good place to park some money at this point.
Yeah. There's a bit of a, there are conflicting narratives going on in oil right now. So as you mentioned, China stimulus should be bullish for oil, and conflict in the Middle East normally should be bullish for oil as well. Although, when Israel did their ground invasion of Gaza, that didn't, any rallies in oil ended up getting sold. So I think that the market is now kind of, feeling or trading more immune to what's going on in the conflict between Israel and its neighbors. So on the bearish side, the main narrative is that Saudis want to increase supply. They're tired of their OPEC partners constantly cheating on them. The Saudis have been trying to manage their OPEC partners to cut production. And what's happened is that the Saudis end up cutting, but their partners keep, producing and cheating above their quotas. So now I think the Saudis are getting pissed off, and they're gonna, teach a lesson to their partners, and they're just gonna go ahead and and pump as much as they want. So, previously when the Saudis have done this it resulted in a pretty sharp drop in oil because the market was afraid of a price war. So it's quite a powerful bearish narrative, which is countering the bullish narrative out of China. And I don't know at the moment which one is going to prevail. I was long oil and just exited my position, and I do think that positioning is quite short, quite bearish. So I think at some point, a rally will materialize just based on China stimulus and positioning alone. But it might take some time.
So I want to ask you about China again, and I know that they rely on exports a lot for their economy to run, but people aren't buying Chinese goods the way they used to. At least their exports have been down a little bit. Do you see that turning around? Obviously, the dock workers strike here in the U.S. doesn't help that, but do you see that turning around as they pump more money into the Chinese economy?
Yeah. So, China stimulating its own economy isn't going to convince the rest of the world to buy its goods, unfortunately. It'll convince their own people to buy their goods, which is actually good for the Chinese economy because, really they need to shift from being export-led to being led by domestic consumption. Um,
Right.
so, I do think that if the rest of the world recovers, like I think it will, the U.S. if the U.S. economy starts to recover from here, if Europe starts to recover from here, that will result in a little bit more purchasing of Chinese exports, but it's not going to be, a game changer. The game changer is really, is really going to come from broader consumption by its own people.
Does that help the US dollar at all that China is exporting less?
Hmm. Yeah, that's a good question.
We're not doing
Yeah.
our dollar any favors with our interest rates. So I'm looking for ways to help us out here.
Yeah. You know, what really drives the dollar is um, US growth relative to the rest of the world. And there's this thing called the dollar smile, which is that, smile shaped like this.
Mhm.
So at the two edges of the smile, that's when the dollar is strongest. On one edge of the smile, um, that's when um, the rest of the world, like China or Europe, is doing very poorly relative to the U.S. On the other side of the smile, you have flight to safety, grab for dollar liquidity, so the dollar tends to do very well. In the middle of the smile is when the entire world is reflating, the entire world is growing, and U.S. is kind of middle of the pack. So China stimulating its economy, um, that's going to move, global economy towards the middle of the smile, which is going to be negative for the dollar. And we're seeing this, we're seeing the dollar weaken against a lot of Asian currencies. Like for
Right.
example, dollar Sing, which, I live in Singapore, and it's been trading between 130 to 136 for God knows how long, like ages. And suddenly it's trading down to 128. So that's a sign. So the dollar is weakening, and I think it's going to keep weakening if China manages to keep its stimulus going.
So yeah, you had mentioned Bitcoin in one of your, or cryptocurrency in one of your articles. Can that change the way the economy works? What's your view on Bitcoin, and are you bullish or bearish on Bitcoin? Where is Bitcoin and cryptocurrency going?
Yeah. So um, Bitcoin has been interesting because we had a huge run up at the beginning of the year, and then it's
Right.
just been sideways
Hmm.
since March. Um, it's supposed to be a risky asset, but it really hasn't kept pace um, with U.S. equities at all. So the question is like, what's it going to do from here? Um, I do think that the backdrop for Bitcoin looks a lot better today than it did, let's say a month ago or a few months ago, and for a few reasons. So the first one is that we have the Fed finally cutting, and so that tends to be pretty good for risk assets. So risk appetite is going to be global uh, risk appetite is going to support Bitcoin. Um, and we also have the lifting of a lot of the supply that was keeping Bitcoin down. So, previously we had Mt. Gox distributions, a few billion there. Um, German government, U.S. government was also selling its Bitcoin. So there was a lot of supply keeping Bitcoin capped. But I think Bitcoin has absorbed all that, and now there's really a lot less supply that's going to keep Bitcoin down in this, 50, 70 range. So I do think that it's only a matter of time until it breaks higher. We also have a lot less supply coming from the Grayscale ETF as well. So
Hmm.
ETF flows are improving. They're almost at all-time highs in terms of total Bitcoin ETF AUM. We also have FTX distributions coming, so that's going to be like a big multi-billion liquidity injection into crypto. Um, So that that'll be supportive too. So I think if these factors can help Bitcoin get above the year's high, above 72, 73K, then we're going to start another, bull market rally in Bitcoin, and that should also lift, the rest of the crypto market as well. As for whether Bitcoin will really change the economy, um, I don't really think it's going to change the economy anytime soon. It's a store of wealth asset. Um, it's kind of like, to what extent has gold really changed the economy? I'm not sure. I do think that blockchain and stable coins, are more likely to change the economy and the financial plumbing. But Bitcoin, I think, is really just going to be a store of wealth asset.
So, with everything going on in the economy, you run a family office. I know you were very bullish on Chinese equities, so that's one place we can be looking to park our money to make some money. Where else? Where else are you looking to make more money?
Yeah. So yes, Chinese equities, although they have run up a lot, and I am long-term bullish, but short-term waiting for a dip to buy. A little bit of short-term exuberance there. Um, I think that one place where people aren't quite looking yet is in European equities. So the European economy tends to be caught in the middle between the U.S. and China. So when the U.S. is growing but China's not, then Europe kind of underperforms the U.S. And when China is growing but the U.S. is not, same thing. Rarely do we ever see both the U.S. and China inflecting higher at the same time. So I think that's going to drag the European economy higher. European equities like the Euro stocks are quite cheap in comparison to, let's say, the S&P 500 or the Nasdaq. Um, and I think that it will play some catch up higher. So European equities, they tend to go sideways for a few months and then suddenly rally by 20, 30% and then go sideways. So I think we're on the brink of another 20% rally. Um, and for me, like I trade futures, I take positions on leverage with like a stop and limited downside. So I kind of like this because I think there's some catching up to do. And from a leverage futures position, I think it'll deliver like a pretty strong Sharpe ratio.
Great. Well, Gio, thank you so much for joining me. I really appreciate it. I know you're in Singapore. It's getting late there, so I'm going to let you wind down your day. But I really want to thank you for joining me. Where can we find you? I know you have a Substack, Firenza, right?
Fidenza. Yep.
Fidenza,
Fidenza
pardon
Macro.
me.
Yeah.
Fidenza Macro. Where else? Are you on Twitter? Any social media where we can find you?
I am on Twitter, but to get my latest and best insights, that's really all on my Substack. So fidenza.substack.com. I post once or twice a week, so all my best stuff is on there.
Excellent. Gio, thank you so much for joining me. I really, really appreciate it.
Yeah, thank you. Thanks for having me. Really enjoyed it.
Absolutely. Thanks so much for watching our discussion here on Wealthion with Geo Chen. It was a pleasure having him, and hopefully he'll be back soon. If you need help being financially resilient, please head over to wealthion.com/free for a free, no obligation financial review. And of course, if you could like and subscribe to the channel, we would greatly appreciate it. Don't forget to turn on notifications so you know when we post new videos on the Wealthion channel. And please do the social media thing with us. All the links are below in the description. And if you like this content and are looking for more ways to achieve long-term wealth, watch this video next. Thanks again for watching. Until next time, stay informed, be empowered, and may your investments flourish.